And on today's show, pension plan risk transfer and structured settlements. Part one of this week's series on defined benefit termination and structured settlements with industry expert Steve Pilger. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and InSmart. Let's get down to business. Well, welcome to the show, Steve.
Thanks, Steve. Great to be here.
Steve, you're going to bring our entire audience of advisors into a whole new world. I have to say, I don't see much on this on the net. I write for a lot of our industrial websites. I don't see much traffic on this. The one part, settlements, yeah, I kind of seen that. But what about this whole issue of defined benefit terminations? I mean, this is a huge market. I didn't realize how big it was.
It is, and a lot of it has been driven by the media. So instead of maybe those of us in the financial services business kind of driving the message, the narrative has now been set by the media. We've seen articles, usually bigger defined benefit plans that have maybe come into problems, usually, because bad news always sells, or from the standpoint of changes made that now the media has kind of fueled the visibility, which now we're, as part of the financial services industry, coming into and saying, all right, there's an area here that's underserved. We need to get out in front of it as best we can to provide solutions for those clients.
According to some of the stats you gave me, which I found unreal, we have 26,000 defined benefit plans in the U.S. Now, when we talk about the press, the negative press, I see defined benefit plans like in the municipalities, they're short.
Yes.
There's a lot of shortfalls for that.
There is.
And so we kind of know this, and I kind of like the media driving our show for a change, right? Because it shows the dilemma. It really positions us to say, hey, listen, everybody's talking about this. And are you seeing more and more employers say, okay, you know, maybe we need to just terminate our defined benefit plan and go into a defined contribution plan of some sort?
The short answer is yes. And within it is really, if you look at it from the plan sponsor's perspective, which is kind of the spotlight that a lot of these articles come with, the consumers are concerned, of course, but from the plan sponsor standpoint is they really have three risks that they have on an ongoing basis. How they manage the assets that they're responsible for on behalf of their participants. Longevity risk, we're all living longer, congratulations, but that all becomes now a risk that the sponsor has to account for. And also from the standpoint of increasing regulation and costs. So these three things kind of combined, even though it's a challenge, there's also opportunities within those challenges, and that's where folks like you, myself, can get in front of those sponsors to talk about what those opportunities might be.
Now, I'm looking at the overall global number here, and I don't know if it's changed over the last month or so, but right now it looks like it, and I think this information is coming from the Pension Benefit Guaranty Corporation.
Correct.
That we're talking about a $36 billion deficit in funding defined benefit plans. I found that number to be so staggering, I don't even know if I can get my hands around it.
It's a big number, but when you think about those 26,000 plans having trillions of dollars of assets that these plan sponsors are managing, yes, $36 billion is a significant number. And frankly, that's something that should be of concern from the standpoint because the Pension Benefit Guaranty Corporation, PBGC, does actually underwrite and guarantee that you and I, if we're participants in a pension plan, are going to get our benefits regardless of what might happen from the company
All right,
standpoint.
so let me just make sure I understand that, because you're saying regardless of what happened in 2008, when assets were just completely demolished, I mean, we're talking about reductions across the board. And I'm not, even though we've had a wonderful run now on the market of about 4 or 5 years, I think most pension plans are just getting back to where they were.
They are. And to give you a couple of stats within the stats, in July of 2012, again, almost 4 years from the recession, the funded status on average of pension plans, and funded status by that I mean $1 of assets to match $1 of promise made to the participants, it was at a 75% funded ratio. That was the low point. Now, with the fact we've had a nice run with interest rates, we had a decent market in 2013, now we're looking at roughly a 95% funded ratio. So again, from where we were to where we are, we're in a better spot, but the fact of the matter is, moving forward, again, uncertainty of markets, interest rates, everything that we cannot control, is how do those plan sponsors best manage their participants' assets?
Well, if now we've kind of went through 2008, and I don't know if we learned our lesson. Now you're saying we're 95% almost to par here. So what makes a third party, or an administrator say, hey, maybe I still need to terminate this plan and start over? What's the impetus? What would make him do this?
The impetus for the plan sponsor is the closer he or she gets to fully funded, so a dollar for dollar match asset to the benefit, that's the opportunity that the plan sponsor looks at is now a time for me to look at this plan and taking it from an active plan where we're actively contributing to it to freezing the plan where it is today and then moving the risk away from the company balance sheet off on highly rated insurance carrier in the form of a group annuity.
Well, I think this is very important because we're so close to being par, as you're suggesting. Maybe this is the time. I don't want to go through another 2008. I think our pension participants don't want to go through this again. This is probably the time. So we really need to alert our advisors. This could be a play for them.
Absolutely it is. And again, because this isn't something that's been talked about from the industry side of things, and now with this media impetus, and we're seeing these things, USA Today, even local papers and whatnot, for smaller municipalities that you brought up earlier, which is an excellent source of these potential transfers, is, of those 26,000 plans right now, 3,000 are currently in a frozen state. So now from that standpoint, that's kind of your low-hanging fruit. Those are the plans that you start with the understanding that, as time goes on, as funding status improves on these plans, more of those plans will go from an active status to a frozen status.
We come back, we're going to dip our toe into structured settlements, they're kind of kissing cousins, really, when you think about it, right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. I'm with Steve Pilger. And, Steve, we're talking about structured settlements. This is kind of a kissing cousin to everything we talked about in the first segment. It is. I think about structured settlement, and I think of J.G. Wentworth. Is that what you're talking about? A
little variation on a theme there. I think J.G. Wentworth maybe is fishing in a different end of the pond. When I talk about structured settlements and when I work with advisors about structured settlements, I'm talking about the standpoint where you have an agreement that's been put in place voluntarily by two parties. And basically one party has agreed to pay another party a lump sum of money that now in most cases is in an injury type of a settlement situation. Sure. Where now that lump sum is going to form a series of periodic payments to the claimant or to the person receiving the money over an extended period of time. So not exactly what we see on TV, and again, it's not usually something we see from a commercial standpoint, again, but it is there, and it goes on every day across America.
So when we talk about defined benefit plans that we're thinking about freezing, how do I integrate this idea of structured settlements and make this a tandem idea?
The tandem idea, in how I'm doing it, just one guy's opinion, is the fact that you look at two segments of our marketplace where really there are solutions there, but it's asking or knowing which questions to ask to kind of elicit and find the opportunities that present themselves. Specific to structured settlements are situations where, again, maybe I'm a financial advisor in small town America, and one of my clients comes to me saying, there was an injury, there was a wrongful death, or there was some type of a situation now where that client's involved in a settlement negotiation for a lump sum of money. Well, what I want to be able to do as the advisor is have that light bulb go off saying, okay, this is something where I need to go to carriers, to financial institutions that can help me distribute that money as equitably as possible within the law that was put in place back in 1982.
How can I engage in this marketplace as an advisor? I kind of understand the defined benefit plan. How do I find out where the players are and so forth? Is that something that you keep a track on, or how does an advisor get a hold of that kind of information?
My experience has shown that advisors, in what they're already doing for their clients, their core business, they're managing their money, their retirement, they're doing various things for their clients as part of their core practice. Sometimes just a very simple, oh, by the way question, or from the standpoint that the client has a comfort level with me as the advisor that these types of situations come up. So on the one hand, it's very reactive, but what I'm also finding is again, if you have some resources and you're aware of some resources that are available to you, you can make it and kind of turn it around and make it more of a proactive type of a discussion for clients that are going to find themselves in this position.
How many carriers? Is this a limited pool of carriers that
We
are
have
playing
about
this
12
league?
carriers with whom I do business, all highly rated. They have specific segments of their company set up just for structured settlement business.
When I look at this, if I only have a limited amount of carriers, and we don't really have a lot of advisors in this field yet, so this is a really virgin territory.
We do not, and the interesting dynamic there is we have fewer and fewer what I'll call structured settlement brokers in the U.S. We have less than 500 in the country. So if you stop and think about that in the country.
Wow, that seems small.
And if you think about it from the standpoint of the size of our country, small, large, segment, regionally, however you want to do it, that's a very small proportion of potential advisor or broker to a client who has this need. You couple that with the insurance carriers. 15 years ago, most major insurance companies in the business had some type of structured settlement department. Well, over the last number of years, market, interest rates, all of the things that we've experienced in the marketplace, there are fewer and fewer carriers in the marketplace. But as I indicated, with the 12 with whom I work, still highly rated, some of the biggest companies, well-known names in our business, in the insurance business, have set up and maintain, and in some cases are even growing, their structured settlement part of their business.
This is all annuities, right?
It is.
All the annuities.
It is.
So if I'm looking at, and so as a structured settlement, do they go back to any of this defined benefit plans to pick off some of this settlement issues, or no, these are completely distinct?
This is a different tool in your box. Yes, on the defined benefit plan, we are talking about eventually systematic payments coming out of your retirement plan. With structured settlements, you really have two pieces. You have kind of what's called the qualified market, which is more of a court-ordered type of arrangement, wrongful death, workers' comp, personal injury, those types of things where there's mediation involved, the parties come together on an agreement, and then it sets in place the structured settlement type of arrangement. You have other non-qualified type situations where maybe you had some problems with your contractor, you're building a house and something didn't go right, and now there's some litigation involved. A structured settlement arrangement can be put in place in those types of situations as well.
You gave an example that I thought was really curious. How do you have a market opportunity with the BP oil spill? That was kind of a unique story.
Well, it's a unique story, and again, recently, media kind of driving some of that message and some of the recent reports, and the BP oil spill as a mass tort type of an opportunity, and as those cases really start cycling through and coming to fruition, that's another area that structured settlements, that's right in the wheelhouse.
It's so huge, that could be a market in and of itself.
Yes. And again, you mentioned J.G. Wentworth a moment ago as far as opportunities. Let's face it, you watch any cable channel now, commercials are usually full of, any type of mass tort or those types of settlements where, if you've been hurt or harmed, well, that kind of lends itself to the structured settlement marketplace.
It's all very interesting, and thank you for the introduction for this show. That's all the time we have for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? You can hop out to our site, downtobusiness.ashbrokerage, and catch any of our past shows. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.